Annual percentage yield plays a crucial role in subnet token valuation, but it's more complex than traditional staking rewards. In the Bittensor ecosystem, APY isn't just about holding tokens, it's about actively contributing to network utility. High APY can be a double-edged sword. On one hand, it attracts participants and provides strong holding incentives, which can support token price. On the other hand, extremely high APY often indicates high inflation rates, which can dilute existing token holders if the network isn't generating proportional value growth. The key metric to watch is real APY. That's the nominal APY minus the inflation rate. If a subnet offers 50% APY but has 60% annual inflation, holders are actually losing purchasing power at a 10% annual rate. What makes subnet APY particularly interesting is that it's tied to performance. Unlike simple staking rewards, subnet participants earn tokens by providing valuable AI services. This means APY should theoretically correlate with network productivity and value creation. However, this creates a feedback loop. As more participants join seeking high APY, the increased competition can drive down individual rewards unless network demand grows proportionally. This natural balancing mechanism helps prevent unsustainable APY levels. For valuation purposes, sustainable APY levels typically range from 8% to 25% in real terms. Anything significantly higher suggests either exceptional growth opportunity or unsustainable tokenomics that could lead to future corrections. The impact on valuation is straightforward. Higher sustainable APY increases the present value of future token holdings, supporting higher current prices. But the emphasis is on sustainable. Temporary APY spikes often lead to price volatility rather than lasting value appreciation. Let me be direct about where I see the current subnet token market. We're in the early stages of price discovery for assets that do not have established valuation frameworks. This creates both significant opportunities and substantial risks. Looking at the current landscape, I believe most subnet tokens are trading based on speculation rather than fundamental value. This isn't necessarily bad. It's typical for emerging technologies, but it means we need to be realistic about what we're buying into. The positive case is compelling. We're seeing subnets that are generating real utility, processing meaningful AI workloads, and creating tangible value for users. Some subnets are handling thousands of inference requests daily. Others are facilitating AI model training, and a few are building specialized AI services that would be difficult to replicate elsewhere. However, the current token prices often don't reflect these fundamentals. Many subnet tokens are trading at valuations that would require massive growth to justify current prices. We're seeing revenue multiples of 100x or more in some cases, which would be aggressive even for high-growth traditional companies. The disconnect stems from several factors. First, there's limited liquidity in many subnet token markets, which can lead to price distortions. Second, the complexity of valuing these assets means many investors are relying on simplified metrics or following crowd sentiment rather than conducting thorough fundamental analysis. Third, and perhaps most importantly, we're still figuring out what sustainable tokenomics look like for AI networks. The technology is evolving rapidly, and optimal economic structures are still being discovered through trial and error. My personal view is that the sector is roughly 12 to 18 months away from more rational pricing. As subnets mature, develop clearer revenue models, and demonstrate sustainable growth, we'll see valuation methods become more standardized and prices become more closely tied to fundamentals. That said, the long-term potential remains enormous. AI is transforming every industry, and decentralized AI networks could capture significant value from this transformation. The question isn't whether subnet tokens will be valuable, but which ones will succeed and at what prices. For investors, this environment requires careful selection and appropriate position sizing. Look for subnets with clear utility, growing user bases, sustainable tokenomics, and strong development teams. Avoid chasing short-term price movements or investing based solely on APY numbers. Subnet token valuation represents one of the most interesting challenges in crypto today. We're attempting to value assets that combine elements of traditional equities, utility tokens, and AI companies, all while operating in a rapidly evolving technological landscape. The key takeaways: understand the fundamental differences between subnet tokens and traditional cryptocurrencies. Use multiple valuation approaches rather than relying on any single method. Pay careful attention to real APY rather than nominal rates, and maintain realistic expectations about current market pricing. The space is evolving rapidly, and those who take the time to understand these complex dynamics will be better positioned to identify genuine opportunities among the noise. For a much deeper dive into subnet tokenomics and valuation methodologies, definitely check out the Unsupervised Capital article linked in the description. It provides additional technical detail and analysis that complements what we've covered today. What are your thoughts on subnet token valuation? Are you seeing opportunities in the current market, or do you think we're still too early? Let me know in the comments below. And don't forget to subscribe for more deep dives into the intersection of AI and crypto. Thanks for watching, and I'll see you in the next video.